Al for the nice introduction, and thanks for putting this event together. We really appreciate it. What I'd like to do is share with you what our firm does and something called a strategic allocation model. So we are what's called a macro manager, and what I mean by that is, how many of you have attorneys, bankers, CPAs, maybe insurance professionals? How many of you have ever had them in the room at the same time? Probably. Oh, that's great. And how much does that cost you, by the way? It's probably very expensive. So what we do is we sit in the middle with you and we help coordinate all their advice. What we found is that most of them are trying to give you the best advice possible, but they don't necessarily know what the other advisor is doing. So we help coordinate everything that they do. I'll be the first to tell you that we are not a good fit for everybody. In fact, we're probably a good fit for a select few. Primarily, we work with real estate investors and entrepreneurs. Typically, they have several concerns. One of them might be minimizing their taxes. How do they get the maximum QBI deduction? Does anybody know what that is, by the way? The new tax law? Some of them are concerned about how their entities are structured, whether it be a sole proprietor, partnership, LLC. Some of them are concerned about retirement distributions, how their assets are allocated, and how they might be able to get involved in alternative asset classes, such as private equity, oil and gas, real estate syndications, which we're big believers in. In traditional financial planning, they use what's called a silo approach. And what I mean by that is they have these different buckets or silos. So they have money earmarked for emergencies, for retirement, maybe a second home, different buckets, and your money is just sitting stagnant. So in our planning, we use a strategy approach. It's much easier to protect your wealth. We use something called the velocity of money. It gives you greater flexibility and increased liquidity. So we use an economic model. Have any of you ever seen this before? Yeah? That's pretty bad. So this is a model that was developed by an economist in the 1980s. It has remained unchanged since the 1980s. Everywhere you can put your money in the United States is represented on this model. And it's got three separate components: protection, savings, and growth. So in the protection component, we have things such as all your property and casualty insurances, maybe disability insurance, government programs, Social Security, but also your wills, trusts, ownership interests. You might have LLPs, LLCs, partnerships, and the cornerstone, which would be life insurance. The second component would be the safety component. In here we have things such as money markets, CDs, savings accounts. Also tax deferred would be things like annuities, cash value life insurance, Roth 401k IRAs, 529 plans. And this last drawer would be regular IRAs or any type of qualified plan. And then finally we have the growth component. And then we have things like bonds, stocks. But besides traditional asset classes, real estate, hard assets, again, businesses, tax shelters, private equity, gold, things of that nature. So we're going to talk about a strategic allocation model, basically a general guideline into how you should allocate your money. We also focus on cash flow and debt management. So the first rule is to protect your assets. If you notice in our model, it's arranged in a certain way: protection, savings, and growth. And I realize many of you have been taught the opposite. Go right into growth, then maybe a little savings, and maybe protect your assets. Back in feudal times, what was their wealth? Anybody watch Game of Thrones? Yeah, it was land, gold, artifacts. They put it all inside the castle. And what did you always see around the castle? A moat, that's right. So our number one rule is we believe in building a moat around your castle. Now, Now, we try and do that by minimizing premiums. So maximum protection, minimum premiums. Most of the people we start working with are the exact opposite. The second rule is we want to save 15% of your gross annual income into this model. Does anybody know why 15%? Anybody ever fly out west, California, anything like that? And how long did it take you? And how about coming back? And why does it take more time going to California? Headwinds, that's right. So everybody here is flying into a financial headwind and they don't even realize it. There are these wealth eroding factors such as taxes, inflation, planned obsolescence. We all have to replace cars, roofs, water heaters, all that good stuff. Technological change, propensity to consume, meaning the more we make, the more we spend. And these factors work against us at a rate of 10 to 12%. So we need to save 15% just to stay current. Now, when we meet with clients, many of them are not actually saving that 15%. And quite frankly, it's not our job to tell you, don't drive the car you're driving, don't go out to dinner. So when we work with clients, we are not here to tell you to change your lifestyle. We have a different way to try and find that money. So think of a bucket, and you're trying to fill up the bucket, you pour water in the bucket, but the bucket has a couple holes in it. And you can either continue to pour more water at a faster rate, or what you can do is you can plug up the holes and then fill the bucket. So what we actually do is we look for inefficiencies in your cash flow, plug up the bucket, so to speak, and then give that money back to you so you can save that 15%. This 15% is going to go into something called a wealth coordination account. And that is a checking account strictly dedicated to building wealth. We want to build a wall between lifestyle and building wealth. This account will also allow us to illustrate taxes, measure results, and it's going to provide for the easy movement of your money to different areas in this model. So it's the heart of the model. Think of it this way. Much like your heart pumps blood throughout your body and then back into your heart, this account is going to move money to different parts of the model and then back into this account. The second rule, or the first place that the wealth coordination account is going to move money to, is in these drawers, and maybe down here, cash value life insurance. But we want you to have a minimum of 50% of your gross annual income liquid. Does anybody know why? Yeah, number one obvious reason would be emergencies. But that's not the only reason. By having 50% liquid, it helps us avoid taking on bad debt. It provides stability to the growth portion of the model. And maybe most important, it's there for opportunities. So if you think of 2008, 2009, the stock market crash and the real estate market going down in a lot of states, what would happen if you were sitting on a pile of cash? Tremendous opportunity. In fact, 2010, I was fortunate, I was hooked into a network in Arizona. And these properties were selling for 40 to 50% less than they were the previous year and a half. And if you went out there and you tried to buy one of these properties, it was basically like bidding wars, but it was all cash buyers. If you had to finance anything, forget it. You weren't getting anything. So we want to have that money liquid in case an opportunity comes up. The next rule is once we have this at the optimal level, meaning a minimum of 50%, we are not going to compound the interest. We are going to move the interest out back into this wealth coordination account. And I'm sure many of you have heard about the miracles of compound interest. But what I'd like to do is share with you what really happens. The question. So if we look at this, let's say we have 200,000 sitting in an account, maybe a money market, and we have a really, really good money market, and let's just say they're paying us 7%. And what most people look at is they look at this. They get their account statement, their money's growing, isn't that great? And really the way compound interest works is, okay, year one, 14,000, year two, you can see my interest going up. But as my interest is going up, what's happening with this tax? It's going up. Does anybody know what rate? It's actually going up at the same rate that I'm getting on that account. So if I'm getting a 10% rate of return in my money market, that sounds like it's great, but the reality is that tax liability is compounding at 10%. And of course, most people don't realize this because what happens is that institution sends you a 1099, you give that to your accountant, and they just factor it in with all the other taxes, and either owe or you get money back. It's one or the other. If you look at this, this is what we recommend. So if this money was sitting in a money market at 7% interest, what we're saying is we're going to leave it sit there, but we're going to move this $14,000 interest out each year back into that wealth coordination account, and we're going to move it somewhere more efficient. And if that happens, you can see what happens ongoing on a year basis. So year two, not a lot, but I'm saving $343. So essentially what I would have is a money market or somewhere liquid with $200,000. That interest is being moved out into the wealth coordination account. But then I also have this additional cash flow, which I can take and invest. And this is just showing you over the course of 20 years, I would have saved $103,000 in taxes by using this strategy. That's not really the whole story because there's something called an opportunity cost. Does anybody know what that is? So think of it this way. If you lend me $20,000 and I said, okay, I'm going to pay it back in 5 years, would you just want the $20,000 back? No. Why? Yeah, you could have earned some sort of return on that money. So that's what an opportunity cost is. If I have to pay $1 tax, it doesn't just cost me the dollar. It costs me whatever that dollar would have grown to at a certain rate of return over a period of time. Does everybody understand this? The second rule, after we have the 50% liquidity, is we may want to contribute to a qualified plan only up to the match. That may be a little bit different than what you've heard of. How many people here have IRAs, SEPs, qualified plans? What is it that you like about it? Okay, that's one. Anybody else? Tax deferral? How about the pre-tax? That too, right? Many people think there's a tax savings up front. In fact, I've had many accountants tell me that if I invest $10,000 in a qualified plan and I'm in a 30% tax bracket, that all of a sudden I have this $3,000 that I can take and invest somewhere else. Anybody ever hear that? Let me go over that with you. So this was a client, let's say they're making $250,000 a year. They made a contribution of $40,000, itemized deductions of $50,000. So their taxable income is $160,000. The tax they paid was $56,000, and they're left with $104,000. This client didn't make that contribution. So they have the same itemized deductions. Taxable income would be $200,000. Their tax is $70,000, but they have $130,000 left over. So if person A had expenses of $104,000 and they spent all that money, how much do they have to take and invest somewhere else? Zero. So where exactly is that tax savings? It's actually in the plan itself. What's really happening is, if you make a $40,000 contribution with these tax rates, you're putting $26,000 into the plan, and the government is putting $14,000 into the plan. And whatever rate of return you're getting on that account, even if you did a great job investing, Uncle Sam's going to get that rate of return on their tax dollars. That's why they give you an incentive to do it. Everybody understand this? A couple other quick things about qualified plans. Who controls how much money you're allowed to put in? Government. Who controls how long it has to sit there? Government. Who controls when you have to take it out? Government. Who controls tax rates in the future? And who controls how much you have to take it out? At a minimum, the government. So how does everybody feel about the government having this much control over their money? Let's say you did a great job saving. Doesn't matter what you invested in. And let's say you've accumulated $3 million in your qualified plan. And the day before you're about to retire, Uncle Sam raises income taxes to 90%. Could they do that? Absolutely, they can do it. And then how much would your qualified plan be worth? Not much. This is actually a history of the top marginal tax rates in the United States. I think it goes back to 1917. So look at these periods. You can see for almost 40 years, the highest marginal tax bracket was anywhere from 65 to over 90% tax. Then it got lowered in the 80s, increased again, 90s, lowered again, increased again, and recently we're down here. So my question is, where are tax rates going to be in the future? More than likely, but who really knows? And that's the point. So if you have a qualified plan, you need some sort of exit strategy from this qualified plan. Everybody understand that? Think of it this way. Let's say you have two farmers, Farmer A and Farmer B. And Farmer A buys the seeds, he doesn't pay taxes on the seeds, he plants it, he has a big successful harvest. And when he sells the harvest, he has to pay tax on the entire harvest. Farmer B buys the seeds, he pays the tax on the seeds, he plants them, again, very successful harvest. But when he sells the harvest, it's tax-free. Which farmer would you rather be? Right, Farmer B. So that would be similar to a Roth, for example, and Farmer A would be a traditional qualified plan. We may contribute to a qualified plan. If we do, that's fine. If we don't, that's fine as well. But then what we're going to do with this wealth coordination account is we're going to move money into traditional asset classes. Bonds, stocks, and then eventually into hard assets, such as real estate, businesses, tax shelters, private equity, oil and gas. There's a lot of alternative investments out there that most people aren't even aware exist. And then like we did with the compound interest in that money market account, we are going to move any interest, positive cash flow from real estate, maybe short-term capital gains, back out of these accounts and into this wealth coordination account. So when it's all said and done, it should look something like this. 15% of your money is going into this wealth coordination account. From there, it's going to get moved into these drawers until we have 50% of your gross annual income liquid. We may contribute to a qualified plan, we might not, but then we're going to move money into bonds, stocks, traditional assets, and then ultimately into hard assets, and maybe some alternative asset classes. And then any interest, dividends, positive cash flow would get moved back into this wealth coordination account. If you do this and you allocate correctly, you will have many more sources of retirement income than just Social Security and IRAs. For example, we may collect Social Security, we may not. Who knows if it's going to be there. But in addition, we might have income from family limited partnerships, maybe income from charitable remainder trusts, various other trusts, dividends from life insurance, withdrawals from life insurance, interest from these liquid accounts. Not only interest, but we want the ability to spend down that money without the fear of running out. Potential annuity income income from Ross, maybe pension plans, but pension plans that we could take on a single life-only basis. The ability to spend down this account, again, over a single life expectancy rather than a joint life expectancy. Let me explain that to you. With a joint life, meaning husband and wife, that's a much longer time to spend that money. Over a single life, if you were able to spend it over a single life, it's a shorter amount of time because normally the one spouse is going to outlive the other spouse. Normally women outlive men. And if you spend it over a single life, you have more income. So we try and put you in a position where you're able to take advantage of that, have more income without the fear of running out. So this is the model that we utilize. Does anybody here play golf? Okay, great. And if you bought the best golf clubs money could buy, how many strokes might that take off your game? Maybe a few. I might actually go backwards. But what if you took lessons and you worked on your swing every single day and your swing improved? How many strokes might that take off your game? Probably a significant amount more. So the point is this. It is not the clubs, it's not the products that's most important. What's important is the swing, the strategies that you utilize really to invest your money in assets. And if you look at it this way, think of it, this is a golf course. And the idea is to keep the money, or keep the ball on the golf course and not go out of bounds anywhere. And we are like caddies. What we do is we help guide you around the golf course. Any questions so far on this? Okay, great. Don't have a lot of time, but what I'm going to do is share a couple strategies that you may be able to take to some of your clients that we've used with our clients. Did everybody see that okay? Okay. So, we had a client, 48 years old, wanted to send his kids to college. He had two kids who were going actually 2 years apart. And at the time, he predicted college was going to be $30,000 a year. This is a while ago, obviously. And with inflation, obviously, that was going to go up. So he figured about $240,000, maybe a little bit more, and he was good. He was able to fund their college education. He actually saved $500,000 in zero coupon bonds. He was in a high tax bracket. At the time, they didn't have Section 529 plans, so this was his strategy before he met us. In an ideal world, in a perfect world where he didn't have to pay for college, if he left that money in the account at 4%, he'd have close to $1 million, $973,000. Unfortunately, that wasn't the case. He did have to pay for college. So he ended up paying for college, and at age 65, he would have $400,000. They didn't have to pay for college. They'd have $973,000 at age 65. After college, they had $400,000. So college didn't really cost them $240,000. It really cost them close to $600,000. And that's because they lost use of that $240,000. They could have had that invested somewhere on their model and done something with that. 529 plans, having different accounts. All these strategies, whether it grows tax-free or not, the problem is, ultimately, you're taking money off your model and you're giving it to the college and then it's gone. What we actually had this client do was take that money and he bought a rental property. And the positive cash flow from the rental property was about $48,000 a year. So he used that income stream to pay for college. There was a couple of years where that wasn't enough. He used his credit line on his house and then paid the credit line back with this income stream. And the result was a significant increase in wealth. $1.2 million after college as opposed to $400,000. The reason is because that money never left his model. He invested in the properties, he still owns the properties, and he's still getting income from those properties. Okay. I think it depends on the person. However, again, you're locking up your money in a 529 plan. You only have one use for it, and ultimately, you're giving that money to the college. It also does go against you for financial aid. If I recommend not putting money into a 529 plan.
In your model, was he financing that rental property, or did he?
He paid cash, because he had already saved $500,000 in the municipal bonds, so he just took it and bought a property. What's interesting is, when I showed this strategy to the client, he started laughing. I said, well, what are you laughing at? Well, my dad was a real estate developer, and he bought rental properties all along Villanova, and I actually lived in one of the properties, and that's how he paid for my college. It's amazing how we're indoctrinated with 529 plans, qualified plans, everything you see, everything you read. That's not always the best strategy.
Excuse me, I have one question.
Sure.
Was that income stream, did that factor in the depreciation, or was that just pure net income on operating?
That was just positive cash flow. And of course, you're right, he did have other benefits, tax benefits from owning that real estate. Speaking of which, something I forgot to cover, one of the benefits that somebody mentioned of a qualified plan is tax deferral. And that is that anything that's growing inside a qualified plan, you're not paying taxes on a yearly basis. And that really is a good benefit. But think about this for a second. If I go out and I buy a rental property, as that property is growing, am I paying any taxes on that growth? That's tax deferral. It's the same thing. However, when I sell that property, what type of tax do I pay? Capital gains tax. And when I pull money out of a qualified plan, what type of tax do I pay? Ordinary income tax. I can tell you that most of you probably in this room would much rather pay capital gains tax than ordinary income tax. This was another client we had, a physician, and again, his accountant, max out your qualified plan. And that's what he was doing. I said, what is it that you like about it, and how do you plan on getting the money out? He said, well, I'm going to be in a lower tax bracket when I retire. Now, this particular client was maybe 17, 18 years ago. He was making $750,000 a year. He's now making close to $1.7 million a year. And he saves his money. He was driving around in like a 1990 little red Toyota pickup truck with 200,000 miles on it. So I said, how are you possibly going to be in a lower tax bracket when you retire? Again, it's these pre-programmed answers, because that's what everybody says, so it must be true. If he kept his money in the qualified plan and he earned 6%, he'd have $1.8 million at retirement. I said, Bob, what do you think your accountant's going to say if you tell him, I want to pull out my $1.8 million and I want to spend it? What do you think his accountant told him? No, don't do that. You want to keep deferring it until you hit the required minimum distributions, right? I mean, that's most people's strategy in a qualified plan. Well, think about that for a second. You've been saving for 20, 30 years. You haven't touched that money, and now you don't have the right to spend it. It's kind of like having a castle, but being locked out of your own castle. It makes no sense to me. But if he pulled this money out, he would pay a significant amount of tax. This particular client was a physician. He was also renting his office. He was paying about $3,800 a year. So what we had him do is take, now this is a little bit oversimplified, but take this $48,000 and he financed a building for his office. So he's now owns his own office. We formed a separate partnership, and his practice actually pays the partnership on the office. So after the rent, using this money for the mortgage, this was his positive cash flow. We then took $30,000 a year, and we ran it through a life insurance policy because there is some significant tax benefits to doing that. Plus, he had a permanent death benefit on that policy. Again, you can see at 65, instead of having 1.8 million, he has 2.3 million. Now, to be fair, he still had a loan balance of $352,000, but even if he paid that off, he'd still have $2 million, significantly more than a qualified plan. And if he decided to sell this asset, again, what type of tax would he pay? Capital gains. We gave this client some additional options that if he wanted to sell the property. So again, he has this, at age 65, he had a permanent paid-up life insurance, which means at some point, his heirs are getting close to $2 million income tax-free. Because he's going to die, it's just a matter of when. It's true. So you might as well use that to your advantage. So what he may consider doing is he can take this building and donate it to something called a charitable remainder trust. Anybody ever hear of that? He's basically donating it to charity. And what happens is it goes into this charitable remainder trust. The trust would sell the property. The trust avoids capital gains tax. So he would still have this $1.4 million working for him. Now him and his wife get all the income during their lifetime. He also gets a current income tax deduction because he just gave away $1.4 million. He can use that against his current earned income, or he can use it against future years. The disadvantage is that when he dies and his wife dies, his heirs will no longer receive this building or that $1.4 million. That's kind of where the life insurance comes in. Because when he dies and his wife dies, his heirs are going to get $1.9 million income tax free. Any questions on that? Okay.
Income tax free part is because of the donation.
Well, what happens is he donates this to the trust, and the trust would sell it. So because it's a charity, they don't have to pay capital gains tax. Then on his tax return, it looks like he just gave away $1.4 million. So he gets some income tax deductions for that. What I was talking about income tax free is this death benefit on this life insurance. When he dies, his heirs will get that income tax free. That's how it's written into the tax code. Does this strategy make sense? Okay.
Can we go back to the first example, because you're talking about 529
Yes.
in the investment property. My first question is, if we already put some money in the 529, what's the penalty to withdraw the money from 529? And second, you mentioned that 529 is not good for you when you apply for financial aid. And how about, you mentioned you suggest the client to invest at the investment property, but won't that also be counted against your financial aid?
Yeah, it absolutely would be. As far as getting the money out of the 529 plan, I would just leave it in there and use that for college. What I'm really talking about is an overall strategy. Maybe you don't contribute any future money to those 529 plans. And there's other strategies besides buying the rental property. The whole idea is to not give up control of that asset to the college. So there's other ways to do it besides the rental property. Sure. Does anybody else? Go ahead.
So in your, maybe the overall assumption, what's the overall assumption in buying the rental property? As in what's the rate that you're getting, like in rental receipts, like expenditures that you get upkeep the property,
Right.
or the sub-property tax? What's the method in that number that you have?
That's actually after all that. Because remember, he was paying $3,800 a month in rent alone, and he had $4,000 a month, excuse me, going into a qualified plan. So the money that he was putting in the qualified plan is now paying the mortgage. So that's a wash. So any of the cash flow is 100% positive minus expenses and everything else. Does that answer it? answer your question? That's all calculated in here. And we don't have time for me to go into all the little details. But essentially, that's positive cash flow from that property. And in fact, what actually happened is he took on a partner, a much younger partner, and the partner bought into the building. Well, my client, again, he's a saver. What he ended up doing is he ended up paying off the mortgage, and then the partner has now a note. So essentially, the interest that was going towards the bank is now going to my client because he holds the mortgage. Any other questions? Go ahead.
Just to clarify, the 529, though, the money in a 529 is still growing and
It is.
and making, and isn't it tax deferred?
It's actually tax-free.
Yeah, so isn't that,
Well, that could be a benefit, but the problem is, no matter how much you have in there, what ultimately happens to that money?
you eventually spend it semester by semester?
Yeah, you give it to the college, which means that now it's no longer in an account earning interest or anything for you. So we look for strategies where you can maintain control of that asset.
Right. So
And-
it still could be part of your,
Absolutely,
Part of the
absolutely.
picture.
And I don't mean to suggest that, everybody here should go out and buy a rental property rather than a 529 plan, but there are normally better ways to fund college other than a 529 plan. Just kind of as a point, that is growing tax-free, but if that money's invested in the market and you lose money in that account, you get that write-off? No. So there's positives and negatives, and our job really is to kind of educate about the positives and the negatives. Go ahead.
The example you used, that 1.9 has to the air, how would the treatment for the heirs on
So the 1.9, this right here, is a permanent life insurance policy. So that is actually the death benefit on the policy. And it's a paid-up policy, which means whenever he dies, that's going to his heirs. And the strategies that he used at retirement, he knows he has this policy. He knows his heirs are going to get that money. Therefore, he doesn't have to preserve assets, and it gives him a lot better options. It's like leverage.
Charitable real estate, right?
Exactly. He might not do a charitable remainder trust if he didn't have that policy, because he also wanted to pass money on to his heirs. And in fact, one of his kids is special needs child. So it's important that even after he's gone, that she's taken care of. Go ahead.
Explain what the permanent life insurance policy is. Is that the same as term life or?
No, and I don't want to get a lot of detail about life insurance, but in this particular case, it was a whole life policy. So term is for a specific period of time, and whole life is just that, for your entire life. Both have a place. It depends on the client. Ideally, that one slide I showed you, if you have 1 times your assets in permanent life insurance when you retire, you're in a much better position, because it gives you the ability to spend down your assets, charitable remainder trust, a lot of other options. Go ahead.
as a financial planner, are you a fiduciary?
I am a certified financial planner, and I'm also a registered investment advisor, which means I do have a fiduciary responsibility to my clients. That's why I don't use traditional financial planning. Anything else? All right. Go ahead. Stop.
Do you have an office?
Just try to stop you, Jim, right?
That's right.
Sorry. Do you have an office here? I'm saying your address is in Pennsylvania.
Yes.
Okay, so you do have an office here?
No, I don't have an office here. We are media. But I come up this way. I do webinars with clients. I actually have clients all over the country. In fact, I was invited today because now's my client.
And Jim does a great job, but I have no way of officially endorsing anybody who's here today. He's awesome, but you make your own financial decisions, but you couldn't get a better financial advisor.
Thank you, Al.
So do you want to give them, before we got to wrap up, do you want to give them anything about how they can contact you if they have questions, or you're going to be hanging around?
Sure. Yeah, if you would like a copy of that strategic allocation model, just email us and we'll be happy to send that. I'd also like to talk about, if we end up working together, how we get paid. So we get paid a bunch of different ways. We are fee-based planners. So if you wanted a full-blown financial plan, we charge a fee for that. Normally 50% up front, and then at the completion of the plan and you being happy, the remaining 50%. That fee depends on your income, your assets, and how complex that situation is going to be. In addition, we also manage money, some in traditional asset classes, some in alternative asset classes. In fact, I think we manage close to around $100 million. So if you didn't want a traditional financial plan, you just wanted us to take a look at your portfolio, we can do that as well. And there's management fees on those portfolios if they're being professionally managed.
What about for somebody who's just starting out in terms of like building wealth? Not
Well,
a lot of assets.
We could certainly work with you. Again, we're fee-based, so it probably wouldn't be a significant fee if you're just starting out. But what we would do is take you through this entire process, look at everything you have on that model. If you think of those as like drawers, what we actually do is go through everything you have, make recommendations, and then we talk about how to build wealth.
All right, this will have to be the last question,
Is
because
there a
we're
range on that?
going to wrap it up.
What can that be for someone like we just said, that's just starting out? Is there a range that someone will pay for that?
So it might be like $1,500 on up, depending on the complexity. I'd like to thank Al for having me here.
Thank you, Jim. Great job.